Welcome to the weekly market update. This live session will cover fundamental analysis in the week ahead, global coverage of current economic data, including major market news, analysis, and events, how to apply the best trading strategies prior to news being released and after. First, I'd like to start the session by giving you some information about me. My name is Ihab Jubil. I was born and raised in Egypt. I have a passion for financial trading as well as teaching. I have been trading for a number of years, mainly on Forex and commodities, and in recent years I have also set up my own trading robots, signals, and website. I host online webinars and seminars on investment and financial trading regularly, and I provide my service to subscribers worldwide. Now let's start the session. The impact from Paris terror attacks to the global financial markets was rather short-lived. Stocks staged a strong rebound after initial dip last week. Meanwhile, policy divergence was back to be the main theme in the currency markets. Dollar managed to record broad-based weekly gain, except versus USI, as FOMC minutes added to the case for December federal rate hike. Meanwhile, Euro and Swiss franc were the weakest, and ECB officials' rhetorics affirmed the case for additional stimulus in December ECB meeting. RBA minutes provided little news to the market, but that was enough to support US's rebound. Bank of Japan left policies unchanged as widely expected, and it triggered little reaction. The upcoming week is not this busy with US bank holiday on Thursday. In the US, the statement for the October FOMC meeting had surprised the market with a hawkish note, heightening speculations of a rate hike in December. However, a look in the more detailed minutes suggested that policymakers remain divided on a number of issues, in particular inflation and employment. The minutes unveiled that several participants judged that it would be prudent to consider additional easing if deterioration of the economic outlook undermines improvements in the development market and impedes inflation from returning to the 2% target. On the monetary policy outlook, it's highly likely that a rate hike would come in December. Rate hike would come in December. After that, the members largely agreed that it would probably be appropriate to remove policy accumulation gradually. Indeed, speeches from several federal members were consistent with the tone of a December rate hike. ECB's minutes for the October meeting affirmed that further easing appeared likely. In the account for the monetary policy meeting, the minutes, ECB unveiled concerns over the insufficiency of current accumulative measures due to a number of external factors. And we could see the reaction of euro by weekend and going down. Bank of Japan left monetary policies unchanged as widely expected. Interest rate was held near zero, while the annual target of monetary base expansion was maintained at 80 trillion yen. Bank of Japan noted in the statement that inflation expectations appear to be rising on the whole for a somewhat longer term perspective. Even so, some indicators have shown relatively weak developments. Economists are divided on the view of whether Bank of Japan would expand the stimulus. Some expected weak inflation. The risk of extended recession could force Bank of Japan to ease further next year. However, there were also talks that Bank of Japan would continue to keep powder dry as long as dollar yen stays above 120. And it's around 123 already now. In Australia, RBA met for the November meeting and revealed that signs of improvement in economic activity in recent months indicated that leaving the cash rate unchanged at this meeting was appropriate. However, they remained concerned about the weakness in inflation. The RBA suggested that slowdown in China and other emerging economies would likely to be more persistent than expected. We retain the view that the RBA would keep its cash rate unchanged at 2% for the rest of the year and likely for the first half of the next year. This week, we will watch these two tradable events. On Tuesday, 24th, at 1:30 p.m. London time, US quarterly GDP. And on 27th, Friday, at 9:30 a.m., UK quarterly GDP. Such a quiet week. I will talk in more details about these two news. US prelim GDP will be released on November 24th at 1:30 p.m. London time. US prelim GDP release is the second release for the third quarter of 2015, which is expected to improve from the 1.5% reading on the advanced release. So it's expected at 1.5%, with the federal likely to commensurate hike in December. A strong release will definitely confirm that sentiment. How to trade this news? We are looking for a deviation between 0.3% from the forecasted figure of 2%. Therefore, if we get 2.3% on the second quarter, it would be US dollar positive, and you will buy the dollar. However, if we get a 1.7% release or worse, then we would be selling the dollar. We will be looking to trade this release based on the retracement trading method. Since this is a high impact release, strong market volatility is expected immediately after the release. You can use the default pairs of dollar yen or euro dollar to trade this news. So we will buy the dollar at 2.3% and or more, and we will sell it at 1.7% or worse. But if we don't get the deviation number, I expect, as usual, the market to follow the pre-release market condition and sentiment, and the dollar will keep going higher. A revised GDP will be released on November 27 at 9:30 a.m. London time. The UK revised GDP quarter release is a second GDP release for the quarter 3 of 2015 period. And since it is the second release for the same quarter, most data have already been made available. It's less likely to surprise the market. But of course, with Bank of England still having rate hikes on the table, a surprise this day could affect the sentiment. It's forecasted at 0.5%, like the previous release. 0.5%. How to trade this news? Since this is the second release of the third quarterly GDP for this year, we are likely to get plenty of reaction if we get a surprise, as most second releases do still have the potential of surprising the market. Considering the recent positive trend in the UK economic data, the positive trend, we may get another surprise release. However, we will still be looking to trade this release using after news retracement method. Our surprise factor is around 0.3%. So we will look to possibly sell the pound at 0.2% or worse, and buy the pound at 0.8% or better. We will buy the pound at 0.8% or better and sell the pound at 0.2% or worse. If our surprise factor hits, the market will most probably move up more than 60 pips or more within an hour, because GDP is a very high impact report. But if we don't get the deviation number, I expect, as usual, the market to follow the pre-release market condition and sentiment upward. So then I'd like to thank you for attending today's webinar. We will hold following webinar next Monday. Goodbye and see you next time.